All right, now we are ready for 9.3. This is dealing more with installment notes, long-term notes receivable. We've let somebody pay out for a lot of months, not just the 30 days. And we want to record the notes receivable and record one of the payments for the notes receivable. So it says that on May 7th, we sold a car to Jill Shelton for $14,860 plus sales tax, 445.8, receiving a down payment. It's a 60-month, 8% installment note for $13,000. So 60 months, that's 5 years, all right? And so, again, we're talking long term. So it'll be year after year after year after year, okay? So for May 7th, it's a notes receivable. And we're in the cash receipts because we are actually receiving cash at this point. NR for notes receivable, 369. Okay. The actual sale was for $14,860. The sales tax was $445.80, and the down payment, so the cash we received, was $2,305.80. All right. So we take the sales plus the tax minus the down payment, okay, and what's left is what they actually borrowed from us, which should come out to $13,000. Okay, and the book gave us that number, but just so you know where it's all coming from, okay, the actual sale of the car, plus we have to add the sales tax to it, and then we subtract the down payment, and what's left is what they're actually borrowing. That's the notes receivable. Okay. Then it says on May 9th, we received cash, which is, we're still in the cash receipts, for Daniel Tony's May payment. Okay, so we looked on here, here's Daniel Tony's payment table. And we're looking at May, so it tells us we're doing May. Okay. And interest changes, principals change because of the way the interest works from month to month. All right, so here we're going to have a principal of 167.72 and interest 75.60. So those two added together is the total amount of his payment. So notes receivable, we're decreasing the notes receivable. Okay, here we were increasing it. Here we're decreasing it. The actual note receivable, 167 and 72 cents. Okay, that's how much the note is decreasing, but we're making money off of him because we let him borrow money. So our interest income is 75.60. Okay, and those two added together, 243. So his total bill is 243.32. Okay, and so this information, well, actually, this information came from right here. All right. Okay. Then the next part that they want us to do is look at the reclassification of notes receivable. So basically, if you think this is long term, right? This is over multiple years. So for each year, we need to record what's the current part of that receivable, what's the current part of that asset. And so that's what we're doing here. And they call it a reclassification entry because it's all within the same financial statement. We're just kind of shifting things around. Okay, so this is kind of an adjusting entry. That transfers account balances between accounts on one financial statement. Okay, so what we're going to do is we're going to take this long-term notes receivable, okay, and we're going to take like the 1 year period, and we're going to reclassify it to a current portion of notes receivable. Okay, so hopefully stop, think about that. You can read about it. But that's kind of what we're doing here. All right. So for December 31st, they're saying that $93,467 of the installment note receivable is expected to be collected during the next fiscal year. Record the reclassification entry on page 15. So it's kind of adjusting entry, but we're actually going to label it as a reclassification entry. So December 31st. Okay, and we're just moving from notes receivable to current portion of notes receivable. And the amount was 93,467. All right. Then after the financial statements, are completed, we're going to do a reversing entry. And this will to restore the full notes receivable. Okay. Account. All right, so just like our other reversing entries, this is on January 1st. It's reversing entries. It's just the exact opposite of what we did. Same amount, 93,467. 93,467. Okay. So none of this affects It does not, or let's say it has no effect on assets or liabilities. Okay? Overall, because we're just moving from one asset to the other. Has no effect on assets or liabilities. And that's it for 9.3.